One of the key decisions you need to make when you're building a financial model is whether you'll do it in real terms, as in you won't take inflation into account, or will you do it in nominal terms, which means you take inflation into account. So as a general rule, we always recommend take inflation into account, because whether you like it or not, it will affect you, especially if your sales price inflation is different to your cost inflation. But especially when you've got assessed losses, this can cause an incorrect calculation. So as an example here, we've got some calculations, and you'll see we've got a profit before tax, so there's our number. We've got a tax calc, and this is in real terms, so we have no inflation. We start with minus 500 assessed loss, and you'll see we calculate, and at a point in time we're eventually taxable, and so you'll see that we start paying taxes here. Now if we add inflation, so you'll see we've included inflation here, so we've got the exact same business. So these numbers, you'll see all they're doing is taking whatever the profits are and just adding inflation into it. The problem here is because of this inflation, when we do the assessed loss calculation, notice that suddenly we're taxable much earlier. And so if you compare these two, you'll see exact same business. The only difference is whether we do or don't include inflation. The one pays taxes only here in year 6. The other one's paying taxes over here in year 5. And unfortunately, you can't tell the taxman that, oops, you made a mistake. Can you just pay him next year? So it's quite important you understand this. Now, the reason this happens is because of this number here. This number here, in both cases, we're starting on the same number, and yet it gets worn down a lot quicker with inflation, but that's reality. Losses you've accumulated in prior years can be used up very quickly just because of inflation. So if you need to go into real terms, we recommend you model it in nominal terms and then take those cash flows and bring it back into real terms. So at least you get the timing correct, because the fact is cash will be flowing out your business in this year. It doesn't matter if the model says it's going to be that year in real terms.